Meet Simon. He is a fund manager at Big Return Capital Management, and he loves his job. He started at Big Returns right after graduating from business school and is with the company now for 10 years. He is heavily involved in the fund strategy and selects the best stocks, bonds, and other securities to maximize shareholder value. But for a few years now, he witnessed growing interest of investors to put their money into so-called ESG funds. That's quite bad for Big Return Capital Management because more and more clients are jumping ship and invest their money elsewhere. Simon urgently needs to do something about this and has been invited to a meeting with the board next week to present an ESG strategy for the fund. But after doing some research, the options of integrating ESG components into the fund's investment strategy seem endless. Let's help Simon to shed some light behind the spectrum of ESG investing so that he can take the best decision for the fund. Commonly used ESG investing strategies by funds include negative screening exclusion, positive screening inclusion, thematic investing, and impact investing. But let's dig a bit deeper into each of those and first look at negative screening or exclusion. Using this investing strategy, Simon will exclude specific companies or sectors that do not meet the desired level of defined ESG standards. Concretely, this would mean that he will scrap companies with high carbon footprints, poor labor relations, bad waste management record, etc. Negative screening, therefore, often means the sheer avoidance of the lowest scoring part of a sustainable investing metric. Sounds not too bad, Simon thinks, but he could also use the positive screening or inclusion strategy, which is the counterpart of negative screening. Following this strategy, Simon would include companies or sectors with a high ESG score that meets the fund's defined ESG standards. He would choose to invest in top performers measured against ESG metrics relative to other investment opportunities. So essentially, into companies that, for example, possess superior environmental records, strong reputations for positive labor practices, and gender equality. It's worth noting that many fund managers view negative and positive screening as two sides of the same coin and follow both investing strategies simultaneously. Then there is also thematic investing. This particular investing strategy allows investors to address ESG issues by investing in specific solutions to them. So let's assume that Big Return Capital Management's clients are very keen on investing in renewable energy or sustainable forestry and agriculture. Simon could put together a fund that holds stocks of various companies operating in these specific sectors, and his clients would be happy to invest their capital into this fund. And lastly, Simon would have the option of choosing an impact investing strategy for the fund. This form of ESG investing strategy is quite similar to thematic investing, with the exception that it needs to fulfill 3 criteria. Impact investing must have the intention of solving an issue through investing in it, so essentially to bring positive environmental or social impact through the investment. Additionality is another criterion of impact investing. It means that the impact will become stronger the more investment is provided for the cause. So, for example, the higher the investment to finance a microfinance institution that hands out microloans to farmers, the more farmers can be lifted out of poverty. Finally, impact measurement is the last criterion that needs to be fulfilled. As impact investing focuses on the effect or outcome to be achieved, reporting the social and environmental outcomes are crucial when following this investing strategy. Simon is relieved. He has gained much more clarity on the various options and strategies that fall under ESG investing and can now make a more educated proposal on Big Return Capital Management's ESG strategy for next week's board meeting.